Hello, ladies and gentlemen. This is Jesse Colombo, Cyber Trading University's Forex and Futures instructor, and I'm excited to launch today's webinar called How to Profit from the Global Currency Market. Hope you're excited as well. I see many familiar people in here, so hopefully you guys get to reinforce the knowledge you learned last time, and my goal is to make each webinar different and unique, even though I'll be discussing some of the basics of the Forex market and other global financial markets that are relevant to Forex. And one of the ways I'm going to differentiate each webinar is by doing a analysis of the currency market at the end of each webinar, and each time it's going to be different. So hopefully I'll give you some actionable analyses that you could possibly apply to your own trading. And also we're going to have a Q&A session at the end where you can ask me questions about Forex, futures, other financial markets, and also financial crises, which is an area that I focus very heavily upon, as you'll see in the next slide. So just introducing myself here, I'm Jesse Colombo, as you know. I'm an economic analyst and researcher, and I first came onto the scene after being recognized by the London Times for predicting the financial crisis. And this was in 2008. And I started warning about the global financial crisis starting in early 2004, so 11 years ago. And I was a university student at that time, and I had been trading for a few years on my own throughout high school and doing my own research. And I noticed a massive housing bubble and credit bubble, debt bubble basically, developing in the United States and also other countries. And I felt that it was my duty to warn about it as best as I could with the resources that I had, which was very little. But thanks to the power of blogs, and we didn't even have social media back then, believe it or not, but using my own website and blog called stockmarketcrash.net, I built a very successful website about this coming crisis, and that's what I used to warn about it. And in 2005, it was recognized by the LA Times as being one of the 4 most highly trafficked housing bubble related websites. So when it all hit the fan, that's when the London Times claimed I was one of their 10 people who predicted the financial crisis. And then starting in 2011, I started to notice new economic bubbles develop around the world after the financial crisis. And I just questioned myself. I almost pinched myself. I said, how could this be? There's no way. We must have learned from the financial crisis, right? And as I did more research, I realized, nobody's learned a thing. The central banks just basically inflated a new bubble, and that new bubble is what we know as our recovery, so-called recovery, because I don't believe in it. And I believe when these bubbles pop, the recovery is going to end. So I started warning about it again on a new website called thebubbleBubble.com. And I called it that because I believe there's a bubble of economic bubbles developing around the world. And this website became popular, and now with the advent of social media, Facebook, Twitter, etc., I built up a following. And then a year and a half ago, Forbes magazine took notice of what I was doing, and then I had my own following, and they were interested in my take on global economics, so they gave me a column on Forbes.com, and it's been a popular column. And I write about economic crises as well as trading ideas that I have that are relevant to these trends that I see, because they go hand in hand. And I had been trading Forex since 2002. So I first opened up an FXCM account back then, and that was when the euro really started to take off, and that was when the dollar was starting to, it basically had a very strong bear market starting in early 2002, and that's when my friend and I stayed up that whole summer. We became nocturnal, and we started trading around 3 a.m. New York time, because that's when, right around the European trading session, that was when the most interesting action was occurring. So Forex and I go way back. Let's put it that way. So, and I recently partnered with Cyber Trading University to teach Forex and futures and other webinars, including swing trading. So we'll be developing those in the future. So let's get into it. What is Forex? Many people are not aware of this term, but it's really a very simple concept, and it's really all it means is the international interbank currency market and the speculative trading of currencies. And Forex just stands for foreign exchange of currencies. So that's where they get that funny-looking term. And Forex is actually a decentralized market, unlike the stock market or futures. There's no single exchange like the New York Stock Exchange or American Stock Exchange. Basically, it consists of big banks dealing with each other directly via electronic communications networks. It's also considered to be an over-the-counter market. And this type of Forex trading is also called the interbank market. So they're all different terms that are describing the same thing, basically. And even though the average person off the street has probably never heard the term Forex, it's actually the most active market with over $5 trillion traded every day. And that's one of the main benefits of Forex, as I'll discuss, is the sheer liquidity, the sheer trading volume every day makes it very easy to get in and out, and it makes for a very efficient market, a market that is not easy to manipulate, unlike small stocks or some small bonds. So many benefits here. Just want to discuss who trades Forex, because most people haven't heard of it, but it's one of the biggest markets out there. So the Forex market is dominated by investment and commercial banks, unsurprisingly, as well as insurance funds and other major financial institutions. And some examples of this, J.P. Morgan, Goldman Sachs, but also commercial banks like Sumitomo Mitsui Banking Corporation in Japan, very heavy players in the Forex market. And also, lest we forget, central banks that intervene in their currencies. So, for example, Bank of Japan, Bank of Israel are very active participants in the Forex market because they're trying to weaken their currencies and trying to manage their currencies in a way that is beneficial for their exporters. So Japan is a major exporting country, everything from Sony to Toyota to Mitsubishi. They export all sorts of goods and services. So Bank of Japan and the exporting corporations in their country have decided that it behooves them to have a weaker currency because it makes their exports more competitive on the global scene. So that's one reason why Bank of Japan has a bias toward having a weaker currency. Bank of Israel is another bank that tries to actively manage their currency because in the past 6 or 7 years, the shekel has appreciated well, at least there was significant upward pressure on the shekel, and that was harming the country's exporters. So Bank of Israel has been working very hard to constantly try to essentially print money to try to weaken their currency against other major trading partners. One of the reasons why the shekel has been so strong, or at least there's been upward pressure on the shekel, has been because Israel has a very hot tech startup sector, similar to Silicon Valley, but Israel is a small country and a relatively small economy compared to, let's say, the United States or Japan. So you have this booming startup sector is exerting a disproportionate influence on the rest of the economy, and you have major multinational corporations from the U.S. and other countries have been buying out these Israeli startups. And in order to do that, they need to transfer billions of dollars worth into the country to buy out these startups. And that's one of the reasons why there's been this pressure on the shekel, and Bank of Israel has been trying to counter that by doing what they can by selling shekels and buying the U.S. dollar, or doing the same thing for the euro, buying the euro and selling the shekel, just to keep their currency weak, just so that their exporters aren't at a disadvantage. Another major player in the Forex market are companies that have overseas revenues, import-export companies, for example. And there are so many companies like this, but some familiar ones are Toyota, General Electric. So they're constantly dealing with large volumes of foreign currencies, and they do their best to try to hedge their exposure or to try to insure against adverse movements that would devalue their revenues that are denominated in foreign currencies. So they're active players in the Forex market. Next are hedge funds, and these exist almost exclusively just for speculative purposes. Their goal is to try to make money for their investors. And by foreseeing Forex trends, major moves in the currency markets and fluctuations, they'll earn a return on investment, hopefully, for people who invest in them. So big players, they're pretty much in every major move that you see, and they oftentimes move the Forex market itself. And last but not least are retail traders. They're definitely a smaller player in the overall market, but they're definitely an important part of the market structure that you have in Forex, and that includes many of you, most likely, if you're trading from home or you're a skilled semi-professional. That's still considered to be a retail trader as long as you're not working with a big bank or a hedge fund or a central bank. And just want to discuss briefly some of the benefits of trading Forex. The first one I already addressed, but I'll go into some more detail. I was saying it's the world's most liquid market with over $5 trillion worth traded every day. And one of the big benefits of that is that you get pretty much instantaneous order fills, unlike some other markets where if you want to move even just large amounts of capital, even millions of dollars, you can get in and out. You can buy and sell Forex and various currencies almost instantaneously just because there are so many buyers and sellers at any given point. So that's one of the benefits. If you have to exit your position really quickly, you can do that in Forex. That may not be possible in bonds or certain types of futures contracts. And certainly some small cap stocks, especially if you're a day trader and you're looking to trade even just tens of thousands of dollars, let alone hundreds of thousands or more, you'll most likely be moving the market. And a lot of times it goes against you and costs you more money in transaction costs to get in and out. Another huge benefit of Forex is most people have day jobs. And obviously many people have a goal to quit their day jobs and become full-time traders, and I do know people like that, and it's definitely attainable and a good goal. But while you're trying to build up to that point, you still need to pay your bills and fund your trading account. So the benefit is that it's a 24-hour market. It pretty much trades 24/5. It doesn't trade on the weekends, but it trades on the weekdays. So if you have a regular job, you can place these trades at nighttime or in the morning before work, and you can put in a stop loss order so that you're able to possibly make profit while you're at work, and you can still monitor your positions, maybe get out during your lunch break or place a trade during your lunch break, or head to the bathroom if you have to and place a trade. But the benefit is you can trade around your schedule. And as I said, when I first started trading Forex in 2002, my trading buddy and I, who is my best friend, we became nocturnal for a summer. We were just high school students. We were learning. It was very educational, very worthwhile experience. And as I said, we became nocturnal. We slept each day, and at nighttime we would be up trading Forex, or at least watching and learning and just trying to absorb the movements with our own eyes and just learning how markets work and how they trade. So a lot of the most exciting moves occur outside of the 9 to 5 hours here in the U.S. So that's a benefit. Even if you want to be a day trader and you have a 9 to 5 job, you can be day trading at nighttime or in the evening. Another benefit is with Forex, you have access to leverage. You can actually, each Forex broker will lend you a certain amount of money that you can use to trade, and you can use it to amplify your returns. And of course, leverage is a double-edged sword, and I do not recommend going above and beyond and using too much leverage, because I believe with leverage, less is more. But with most of these brokers in the U.S., you get up to 50 to 1 leverage. So let's say if you have $1,000 of capital in your account, you can borrow up to $50,000 essentially. I would not recommend levering up to that extent, but the idea of using maybe 5,000, I think it can be beneficial. Part of the reason why is because the underlying currencies that most Forex traders trade do not trade, they do not move a very high percentage compared to stocks. For example, a 1% move in the Forex market in one day is considered to be a big move. Whereas a stock, that would be almost as if nothing happened, because a larger move in stocks would be, let's say, around 5%. So Forex itself is inherently a little bit less volatile than stocks or certain types of futures. So that's one of the reasons why you need a little bit of leverage just to make it worth your while. But I do not recommend using too much leverage. But leverage can also amplify your returns if you, let's say, you do spot a good trend, and let's say you go long and the currency goes in your favor, you could make a significant amount of money. There's no reason why. There are people who become wealthy, very wealthy in Forex, and I'm going to discuss some of those players, some notable figures in the world of Forex. Another benefit of Forex is transparency. Because it is such a large market with so much volume and so many players, it cannot be manipulated to the same degree that a small stock would. Small stock, you're at a disadvantage, or a small bond, for example, or even a small commodity. There are some individual players who can sometimes corner the market, and there's varying degrees of legality for that, obviously, in each country, but it's much easier to manipulate a smaller market than it is for a market that's $5+ trillion per day, and there are so many eyes on it. So you're not going to have one player cornering the euro, for example, which is a big benefit. Another benefit is you can profit whether currencies rise or fall. So there isn't an inherent bias where, let's say with the stock market, the default order that you place is going to be a buy order, or you're investing in a stock or a bond. With currencies, you can go short if you think it's going to drop, or you can go long if you think it's going to go up, and it does not matter. There's no bias where you have to go long, or you're not penalized for going short. Like, let's say if you're shorting a stock, you have to first your broker has to locate the stock for you. You may pay more fees. You may not even be able to find, the broker may not be able to source the stock for you. So sometimes you can't even short, or if a stock is under $5, many times you can't even short it. So there is no such issue with going long or going short in Forex. Also, transaction costs are very low. It's around only $6 if you want to move $100,000 of capital into a Forex trade, whereas it's going to cost a lot more, possibly hundreds of dollars, if you want to do the same with stocks. And then it's also much simpler because there's only 6 major currency pairs, whereas there are thousands of stocks just in the U.S., not including if you want to trade in the UK and Japan and Europe. And if you have certain types of brokerage accounts, you can definitely trade overseas, and there's nothing wrong with that. But for people who are just learning to trade, it makes it much simpler. You only really have to focus on 6 major currencies, and it makes your job easier because you're able to just have this laser focus on that one particular market. And here are the 8 major tradable currencies. One's the U.S. dollar, most obviously. It's the world's reserve currency, and it has the nickname of the buck. And each one of these currencies, or many of these currencies, have their own nicknames that traders on trading desks, probably back in the 70s or 80s when interbank currency trading really took off, came up with these names, and also they each have their own symbols. So in the case of dollars, USD, unsurprisingly, Japanese yen, JPY, the euro, EUR, British pound is nicknamed the Cable, and that's GBP. Then there's Canadian dollar. The nickname is the Loonie, and then the symbol is CAD. The Australian dollar is nicknamed the Aussie, and its symbol is AUD. The New Zealand dollar has a nickname the Kiwi, and that symbol is NZD. And the Swiss franc is nicknamed the Swissy, and that is CHF. That's that symbol. And there are really only 7 major currency pairs, and what a major currency pair means is a major global currency that's paired against the U.S. dollar, and that's because the U.S. dollar is the world's reserve currency. So it's number one, most popular, most actively traded, most quoted, most watched is definitely the euro versus U.S. dollar, especially with everything that's been going on in the last 6-7 years with the pigs crisis and all sorts of issues with Greece and Italy. So definitely had some sharp moves just because all the news that's coming out, all eyes are on Greece if there's going to be a Greek exit or Grexit as they're nicknaming it. So lots of opportunities in that. Also the British pound US dollar, GBP USD, Australian dollar US dollar, New Zealand dollar US dollar, and then there's the dollar yen. Japan's a major trading partner, and Bank of Japan, as I've been discussing a few slides ago, is actively trying to weaken their currency. So this currency pair has moved significantly in the past 2 years, and because the yen weakened against the dollar, and the dollar has strengthened very much so over the past 7-8 months. So definitely there were definitely some big trades and big profits made in the dollar yen currency pair. There's also the dollar franc, Swiss franc right here, USD CHF, and also the US dollar, Canadian dollar. And the Canadian dollar's weakened quite a bit over the past year or so, and that's because one of the reasons why is because it's a very commodities-oriented economy, and also exporting oil is a major industry in Canada. So if oil prices drop as they did, that hurts the Canadian dollar. So I'll be showing you some charts in the next few slides, but I first want to discuss what actually causes currencies to move. Now, obviously, just like the stock market, it's supply and demand, but I want to discuss the various players and how they affect currency movements. So fundamentally, you're going to have international trades going to definitely lead to various currency trends. So if a certain currency is in demand because it's constantly exporting, or you have a major change of exports from one country to another, that's definitely going to cause various strengthening and weakening in those currency pairs, whether it's US dollar versus yen. So international trade's one factor, but even more so, an even greater factor that's going to cause the currency market to move are interest rates and interest rate differentials. And many people don't pay attention to interest rates, or very few people are maybe even aware of U.S. interest rates or the interest rates in the country that they're in, let alone other countries' interest rates. Yet that is what really determines these movements, are interest rate differentials, or the difference in interest rates between two countries or various countries. And the reason why is because every country has their own interest rate that's set by their central bank. And that's what causes capital to flow from one country to another. So capital is trying to earn the highest return possible. So if you had $1 million, where would you want to invest? Would you want to invest in a bank account that's only going to give you a 1% return, or it's going to give you a 5% return? And there are countries out there, usually countries that have not been hit by the financial crisis like the U.S. or Japan, that have higher interest rates, whether it's for bank deposits, if you deposit money in that account and bank accounts in those countries, or if you invest in their bonds, they have higher bond yields, and other fixed income investments. Also sometimes property for very sophisticated investors are trying to earn a higher return. So capital is constantly flowing all over the world trying to earn the higher yield and higher investment return. So that's the reason why if you have one country that has a much higher interest rate than another, capital is going to tend to flow there and their currency is going to appreciate. Another major factor that moves currencies is monetary stimulus, like quantitative easing that the United States started doing around 6.5 years ago. And essentially that involves printing money to try to stimulate the economy, and that happens after a crisis. So after the global financial crisis, the U.S. Fed started to print dollars, and they tried to pump liquidity into the system. Bank of Japan really started doing that. They've done that many times over the past 10, 15 years or so, but they started it up again 2 years ago, and that caused their currency to weaken. And in general, printing money or quantitative easing is going to cause a currency to weaken. So that's a major factor that causes movements in the currency market. As I discussed, two central bank interventions when they try to sell their currency against another currency to try to weaken it. That you have a lot of traders that are trying to watch out for these types of interventions and to try to trade with it and to try to front run it. If they know that Bank of Japan is going to try to weaken the yen, they want to try to go short the yen and go long the U.S. dollar. Oftentimes, these central bank interventions catch traders on the wrong side of the trade. So there have been many times in the past few years where the yen started to strengthen and traders were thinking that there was going to be an even greater strengthening in the yen. And then all of a sudden, overnight, Bank of Japan comes out and they intervened in their currency, and the speculators get punished because they went long or they tried to buy, and now the yen tanked because Bank of Japan intervened. So you'll see that very often in the Forex market. In certain countries, of course, not every country is actively intervening in their currency. Other factors are politics and geopolitics. If you were following everything that was going on in Russia over the past year, it's basically the country's gone rogue and attacked Ukraine, and basically that caused international investors to pull out their capital because they no longer wanted to have exposure to Russia because it's really the country's become a loose cannon, or at least their leader has. And if you're a skilled political or geopolitical analyst and you knew that Putin was going to make a move like he did, and let's say if you were in charge of running a fund or you were a sophisticated trader, you could have shorted the Russian ruble and made a fortune as it plunged against the U.S. dollar. So various ways of trading it. And there are certain ways of forecasting Forex moves, and I'm going to discuss some of them. I'll be showing a lot of charts in the next few slides once we get past these fundamentals. So number one, the most intuitive is fundamental analysis. It's where you're basically doing economic analysis and you're forecasting interest rates, and I discussed the importance of interest rates and interest rate differentials in the previous slide or so. Also looking at GDP, gross domestic product, or the amount of output that each economy or each country's economy produces every year, and that's when you hear the country, let's say the U.S. economy grew 4% this year. That's measured by the GDP. And you also have inflation as another factor that affects Forex movements. So in general, stronger economy causes higher interest rates, and higher interest rates lead to currency strength because more capital is trying to clamor in to that country's investments to try to take advantage of those higher interest rates. But this type of fundamental analysis is a little more sophisticated for retail traders, and would definitely be something to learn later on, or at least be aware of the principles of it, but it's not going to provide the type of actionable information that most of you traders are looking for. So that's where technical analysis comes in, and technical analysis includes price-based analysis that uses chart patterns. I'll be showing some of those. Technical indicators that use price as well as volume, and just looking at trading volume and using that to determine whether big players are moving capital in and out of various currencies, and if certain currency moves are confirmed by big money or big players, certain price correlations among currencies, and using those relationships to forecast moves, etc. Also, there's sentiment analysis, which is a bit different than the other two, but has a lot of value, as I found in my own experience. And it's basically where market participants are polled, or there's various ways of gauging the sentiment that market participants have toward various currencies. So are they bullish? Are they bearish? Are they indifferent? And people who use sentiment analysis oftentimes use this type of sentiment data in a contrarian manner, meaning they want to do the opposite of the crowd, because in the world of trading and finance, the crowd tends to be wrong. When everyone thinks one thing and they all feel the same way, that's typically when the market reverses against them. So, for example, I'm using a stock example, but the same thing applies to Forex. You had back in the late 90s, almost everyone was bullish on .com stocks. They had to go up. That's what they believed. It's just only going up from here. The internet was in its infancy. And even though there was truth to that whole fundamental idea, and obviously the internet's even bigger than it was back then, you had excessively bullish sentiment on the U.S. stock market. And eventually it reversed against those players. And the people who started getting really bullish pretty much around the top are the ones who lost the most. At the same time, another example is early 2009, after the global financial crisis. Many traders really became so excessively bearish on the market and said, I'm never going to be investing ever again. And they pulled all their funds, and that was pretty much where people thought we're going to be heading for the hills very soon. We have to have rice and beans. They thought it was pretty much the end of the world. And that was exactly marked the bottom and the start of this current bull market that we're still in 6.5 years later. So, or pretty much actually just six years coming up in March. And so that sentiment analysis is the idea of basically becoming like the smart money, or becoming an informed trader by doing the opposite of the dumb money. And then also you can forecast Forex moves using political analysis. That's not my forte, but I just wanted to put it up there just to make you aware. And this goes back to what I was saying. If you were aware that Vladimir Putin was going to make a big move against Ukraine, you could have shorted the Russian ruble and made a fortune. And there are hedge fund traders who have done that and have done quite well, because the ruble basically evaporated against major currencies like the U.S. and the euro. So total disaster over there. And also many emerging market currencies like the Turkish lira, and some in Southeast Asia weakened significantly in the past year or so. So I just want to discuss some famous Forex traders. And as I've been saying, most people, average person you're likely to walk into on the street, has never even heard of Forex. And the extent of what they know about currency trading is just if they go on vacation and they try to exchange currencies. They didn't realize you can actually profit on these price differentials and these movements among different currencies. But the big players know that there's money to be made in Forex. And one of them, and the most foremost Forex trader in the world, is George Soros. He's a multi-billionaire. I don't believe he's actively trading Forex now, because he's in his I believe late 80s now. So he's made his money. He's a multi-billionaire, but a lot of his money he made from trading the Forex market. And he became known, at least in the world of Forex, because he so-called broke the Bank of England on Black Wednesday, September 16th, 1992. And what he did was he bet against the pound, the British pound currency. He bet it was going to weaken significantly. And he bet that Britain was going to leave what was known at the time as the European exchange rate mechanism. Basically, this is before the euro, and the different European currencies were tied together. And he bet that it was going to end, or at least that Bank of England was going to pull the country out of that exchange rate mechanism, and it was going to cause the pound to really weaken. And he made $1 billion in just a day or two, just a few days. The entire trade in and out, $1 billion. So that just shows how much money can be moved in and out. And that was back in the early 90s. This, at the time, I think it was only a few $1 billion traded per day. It was certainly not $5+ trillion traded every day, but that just shows you that even back almost 23 years ago or so, that there was this kind of volume that you could trade in it, and that's why it's always been a favorite of hedge fund traders. Another famous Forex player is Bill Lipschutz. He made $300 million in 1 year in Forex. I'll take it. That's pretty good. And Andrew Krieger also made $300 million in one trade in 1987. He bet against the New Zealand dollar. He bet it was going to weaken. And he made $300 million. For a fund, of course. It was his fund, but I'm sure he kept a very significant percentage of that trade. So just to show you the potential here in this market. So now I want to discuss one of my favorite techniques in the Forex market. It's a little-known technique I'm going to share with you today. And it's basically how to follow the smart money, or the really savvy and informed traders who move the Forex market, who definitely receive news before everyone else. And even though you may not have those type of connections personally, you can piggyback off of these smart money traders. And I do that in my own trading, and it really behooves you to be aware of this concept as well. And I'm going to show you lots of charts very soon, so bear with me. So to be a successful trader, you want to be tracking and following the smart money, and you want to do the opposite of the dumb money. And there are many different indicators that you can use as proxies for smart money and dumb money, and I'm sure I'll discuss them in some of my more advanced premium courses in the future and workshops. But one of my favorites is the Commitment of Traders report. It's a U.S.-based report. It comes from one of our regulators called the Commodities Futures Trading Commission, and they publish the positioning of various big players in the currency futures market. And the currency futures market is a little bit different than the standard interbank Forex market, but it is a significant part of the world of Forex, and you don't have to worry about what futures are and what they mean. All you have to do is just understand these signals that are coming out of this market and what these players are doing, because essentially they're tipping their hands here, and you can see exactly what they think about various currencies. So from this report, I'll show you lots of charts, don't worry. There are different categories of traders, and there's one group of traders that are known as hedgers or commercial hedgers, and these are known as the smart money because they're the most savvy and they tend to be the most accurate. And these are not speculative traders. They're not actually trying to make money on Forex, believe it or not, even though they probably could because they're that savvy. But it's market participants who are using the Forex market to hedge or try to protect themselves and their profits against adverse currency movements. And they include major banks that transact large volumes of currency trades, as well as importers and exporters. So they are the market, really. They have a real fundamental need to trade in the Forex market and exchange currencies, and they're not trading just based on whims. They can foresee the supply and demand, and they have top consulting firms that probably do nothing but forecast Forex and related variables that affect Forex, and you can follow them for free. So it's a real benefit here. On the flip side, I always want to know what the dumb money are doing because I want to do the opposite, and they tend to be wrong at all the major market turning points. And what's interesting, they trade in the exact opposite manner of the smart money. And the dumb money they're not dumb people, believe it or not. They're quite smart people, but they become the dumb money when they all think the same way. When they're all positioned the same way in the currency market, that's when they become the dumb money. And they're really what they are is they're just large trend-following funds that invest money for investors. But when they all think the same thing, that's when the market moves against them. And the reason why is because whenever they build up extreme speculative positions, let's say they're all bullish on the dollar, that's likely when the dollar is going to fall, and vice versa. And the reason why is because it leads to what's known as crowded trades. And these crowded trades must eventually be unwound, and that's what creates the powerful move against these speculators and in favor of the commercial hedgers. So on to the charts. So here's an example of the positioning of the smart money versus the dumb money. And I'm showing you the euro. This is euro futures, but it identically tracks the euro-US dollar currency pair that retail forex traders are trading. So if you notice right underneath this chart, the chart of the price action, you'll see certain circles that I have, and you'll see red lines, you'll see green lines. So the green lines are the commercial hedgers or the smart money. And you can see on the y-axis, just look right up, if you look on the right, you can actually see what that means. It means the number of futures contracts that each player or each type of player has in each currency futures contract. So you can see on the right, it says around 200K. That's 200,000 futures contracts. And you can see back, as one example, back in early 2010, the euro was falling. This was really immediately after the whole Eurozone pigs crisis started to break, and people were really worried that there was going to be a breakup of the Eurozone and that there was going to be some sort of a euro meltdown and hyperinflation, and large traders were shorting all the way down. And then eventually, you can see them in the red right there. And then eventually, when they built such a large short position, the commercial traders were doing the exact opposite. As the large traders were selling, the commercial hedgers were buying all the way down. And then right when it reached an extreme, I think it was the commercial hedgers of smart money probably had around 100, looks like 150 to 175,000 long contracts on euro futures. Pretty significant bet. And large traders had almost the exact opposite position on the short side. Well, what happened? Sure enough, as we know, the Eurozone did not break up. Even 5 years later, it's not doing well, but it's still together. And because of this, the euro rebounded. And the large traders who all piled in right at the bottom lost money. And they basically, what happened was a short squeeze occurred, where the large traders then had to buy back their short positions on the futures market, and it caused the euro to rally even more. And the large traders were right. An almost identical scenario occurred 2 years later in the summer of 2012. I remember it vividly. It wasn't that long ago. But there was Greece fears, once again, it always goes back to Greece. Traders and market participants thought that Greece was going to leave. There was going to be another Greek exit. Been hearing this for so many years now. It's really exhausting. Well, the large traders said, this is it. Second time's a charm. We have to go short. They went all the way short 200,000 net contracts, which is an even larger position than they had 2 years earlier, because they were really convinced this is it. The Eurozone is done. There's going to be hyperinflation. We're going to make a fortune. And exactly at the bottom is when they had pretty much their largest position, most aggressive position. And that's when the commercial hedgers, smart money, had their largest bullish position. And that's when the euro rebounded. So here we are, 2.5 years later, and we're seeing an almost identical situation where you've had the euro weakening for a good 10 months. And it's because deflationary fears started to resurface in the Eurozone, and also because of the ECB's QE program in Europe. It's 60 billion euros per month that they're going to start printing starting in March 2015 with an expected end date of September 2016. So the idea is anytime, or very typically when a central bank's printing money, or at least market participants expect that the central bank's going to be printing money soon, it causes the currency to weaken. So now you have the large traders worried about another Greek exit, and they're shorting significantly, and you have the large traders are even more aggressively bullish than they were the last two times. They have over 200,000 net contracts long on the euro. So they're probably expecting some sort of a rebound, even if the euro weakens in the longer term, as I do suspect, because let's face it, Europe is a basket case. They've just got too much debt. Nothing's going to change. It's not like unicorns are going to come down from heaven and somehow erase that debt. And same thing, they have major demographic challenges, a real aging problem. They have just too many people who are of retirement age relative to the working population. So the trend is definitely down in the longer term for Europe. But in the meantime, commercial hedgers are expecting some sort of a rebound or a reversal of the recent trends. So keep your eyes on that. I think that's going to surprise a lot of traders, because you can see how many large traders are short. So now I'm showing you the US dollar index, and I'm always watching this. This is really my go-to starting point whenever I'm trying to analyze the Forex market. And the US dollar index, it's not a currency itself, it's an index, and what it does is just think of it as, let's say, a stock index like the Dow or the S&P 500, where it aggregates or averages many different stocks. Well, that's what the US dollar index it does. It measures the strength of the US dollar versus its major trading partners from Japan to Europe to Canada, etc. So it derives the value using a formula against those other currencies, and this index shows you how strong or how weak the US dollar is doing, or how it's acting. So you can see there's been this major appreciation starting in July 2014, and it's been following up that trend line that I drew in blue. And then who knows, this may continue in the longer run, just because the US is the cleanest of the dirty shirts, as they say. Japan's really in an even worse situation than we are with debt. They have 200% plus government debt to GDP ratio, horrible demographic issues, including aging of the population, very similar to Europe. There are a lot of parallels between Europe and Japan. So many people are wondering, is Europe the next Japan? And Japan's now gone through what's known as two lost decades. 2 decades where the country's economy has basically gone nowhere and struggled with deflation and excessive debt overhang and demographic trends that are only going to get worse. So this is likely to lead to more money printing on the part of Bank of Japan and also the ECB in Europe, and in turn that benefits the US dollar. And so, but that's longer term. In the shorter run, trades become basically too many people jump into these trades and they become crowded trades. So you can see the smart money or the commercial hedgers have their most bearish position on the US dollar index compared to the past 5+ years. This chart only goes back 5 years. So this could be the most bearish position they've had in, who knows, maybe even over a decade. It's very possible. So I'm watching this scenario and how that plays out, if there's going to be some sort of a reversal of the currency trends that we've experienced since this past summer 2014. And also you notice the large traders, the dumb money, are heavily long or bullish on the US dollar index. And as I said, they may be right in the longer run, but in the meantime, that doesn't mean there can't be a pullback. So I would bet on some sort of, at least in the intermediate term, I wouldn't be surprised if there's going to be at least some sort of a reversal, even if temporary, just based on the positioning of these traders. Because no trend moves in a straight line. Even if there's a longer-term bull run, a secular bull run that maybe lasts 10 years or more, nothing's going to go straight up. There's going to be pullbacks. So that's very possible that the commercial hedgers are factoring this in. It's only rational, right? Also, if you notice, this is the British pound. I'm showing you the positioning here of each type of trader. You can see the commercial hedgers are very accurate here too. going back to early, actually, I think that was, yeah, going back to 2009. You can see they became moderately bullish, and there was a slight rebound in the British pound. And then the British pound really weakened significantly into about mid-2010, and that's when the large traders were really betting against the British pound, and then smart money was buying it up. Sure enough, they were rewarded with a big rebound. You can see it's happened several times in the past few years. In early 2013 was a very significant move where you had this massive accumulation of these futures contracts by the smart money commercial hedgers in green. They just buying up. They knew something, and they were rewarded with a trend that really lasted about a year, and that was a significant move in the British pound against the U.S. dollar. And then this past summer, you can actually see I didn't circle it there, but actually it happened there too. This past summer, that's when the commercial hedgers started to become bearish again on the British pound because they knew something was happening. They knew something was ahead. These are very savvy players. And sure enough, they were right at this turning point too. You can see the British pound went from 1.7 against the U.S. dollar to 1.5 recently. And then the cycle repeats again. So you can see commercial hedgers are now long. They think there's going to be a rebound. And I show that blue downtrend line just because it has some significance from the perspective of chart trading or technical analysis that I was discussing. And I like to use these trend lines to determine various market triggers or confirmations. So you can see the British pound broke above that downtrend line, which indicates that there's been a change of trend, that even if it doesn't go right up, at the very least, that downtrend that we experienced in the past 7-8 months is likely over for now, and there's probably going to be some sort of a rebound. And so we could see even more of a rebound because commercial hedgers are still quite long, and I don't like to bet against them. Same story here in the Australian dollar. You can see going back to early 2010, same pattern. Happened in late 2011, same pattern. Every time these commercial hedgers become bullish, they're rewarded. And every time the large traders get really negative and really bearish, you can see these currencies reverse and rally against them, and they get stuck in these short squeezes. So now what's happening is the same thing. You can see the Australian dollar's weakened since I think this past fall. Commodities prices were plunging, and Australia is a major iron ore exporter to China, and iron ore prices have plunged. But now the commercial hedgers are betting that this trend is pretty much overdone. It's pretty much long in the tooth, and they're trying to play a rebound. So, and I'm watching that downtrend line as a possible trigger if I want to go long and I want to trade with the commercial hedgers. That would be one indication to me that there's been a long signals if it can break above that downtrend. And I can see a lot of questions are coming in right now, and I will be answering these questions at the end. We're going to have a Q&A session when I'm done, so do not fret. I will definitely get around to them. I'm almost done. You can see the same pattern here in New Zealand dollar, and it's just amazing. It's really a lot of added confirmation when you see so many markets and the smart money and the dumb money in each of these currencies. Really, they're saying the same thing. What they're saying is that the U.S. dollar index or the U.S. dollar rally is overdone for now, and that the declines of these non-U.S. currencies is probably also overdone. And I have to point out that the U.S. dollar trades in an inverse manner to these other currencies. And that's partly because these other currencies are priced in U.S. dollars, they're quoted in U.S. dollars, but also because the U.S. dollar is the world's reserve currency. So that's what's led to this inverse relationship. So when the U.S. dollar is going up, these other currencies are dropping, and vice versa. So you can see the same thing here. Commercial hedgers are buying up after this downtrend since the summer of 2014. Definitely notable. I would not bet against them, especially when they're all saying the same thing in so many different currencies. So I just wanted to just recap. What is the smart money telling us? We saw how they were positioned, but what does this mean? And I want to first give a caveat. I want to say that beware, because the smart money they tend to be early. Because they're not speculators like you or I, they're not trying to earn trading profits. Timing is not as critical to them. They do not worry about immediate mark-to-market losses. They're not going to get immediate margin calls that are going to bankrupt them, because they're just using these futures as price insurance and trying to insure against adverse moves that erode the value of their revenues in another currency. But at the same time, when they really reach these extreme positions, that's when the market tends to move in their favor. And if, let's say, a currency is dropping over a long period of time, you'll see these commercial hedgers will accumulate, and they tend to do it very quietly. They'll do it slowly. They'll keep buying in. You don't necessarily want to trade in the same exact way as them, but when they really reach these extremes, that's when you should pay attention. So that said, I just want to say that the commercial hedgers probably suspect that this long U.S. dollar, short everything else trade of the past 8 months has probably become crowded. And one of the reasons why they may be expecting a QE-related disappointment in Europe, maybe something that causes it's very possible that the euro could rise if Japan's any model for this type of scenario. When people became worried about the efficacy of Bank of Japan's Abenomics program, you would actually have the yen rally because people were trying to get into cash and get out of risk assets. So that's one theory I have, is that maybe we'll see something similar in Europe, where the euro could rally if on certain scenarios that cause traders to become fearful and to scramble for cash, for example. Another one is if there's a dovish monetary shift at the Fed. Let's say the Fed starts to really worry about the U.S. economy in terms of deflationary impact of this commodities bust, or we're just not hitting our growth numbers or inflation numbers, and the Fed decides, or at least indicates, that it wants to push off the ultimate first Fed funds rate hike. That would probably cause the dollar to pull back and in turn cause the euro to rebound. I just want to show something important. This is a longer-term chart of the U.S. dollar index. And forget everything I just said, just for now, just because I want to focus just on this one aspect I'm showing you, and that's just this price-based analysis. Here's what I find concerning and notable. This is a chart of the U.S. dollar index going back 25 years. And you can see that 93, which is that horizontal line that I drew and I marked up here, 93 was a major psychological level. And the U.S. dollar index in the past 2 months broke out above there. And the reason why this number is significant is because this goes all the way back until, I think it was 1998. It marked the low, and it marked pretty much an important support level before that big rally that finally culminated in 2002 when I started Forex trading, funny enough. Also, it marked a support level back in early 2003. It marked a resistance level in, I believe it was early 2004, as well as late 2005. So you can see the market, the U.S. dollar index, keeps on touching that level, and it keeps bouncing off of it, or at least has over a decade ago. So it's a long-established line, and you can see we recently broke out above that. So this, for me, does tend to indicate that there could be a longer-term appreciation of the dollar, due in part because of those reasons that I mentioned. You have, for example, the fact that Japan's a basket case, Europe's a basket case, and the U.S. is just a little bit better off. So we're the cleanest of the dirty shirts, and that could very much boost the U.S. dollar index. So I had a whole bunch of other slides. I didn't know if I'd be able to get around to them, but I'll be doing a lot more of these. I'm probably not going to continue on with all the other slides because I want to save room for a Q&A session, and this webinar is supposed to go for an hour, but we'll definitely be going back and keep on discussing this in the future. So before we start the Q&A, I just wanted to let you know, if if you are interested in learning more about Forex and possibly getting on the path to becoming a successful Forex trader like Bill Lipschutz, as I discussed, or George Soros, and those are extreme examples, but there are many other people, even if they're not billionaires, they're certainly doing well and can do well with Forex. I'm sure many of you would be happy just being able to work for yourself or even just make extra money while you still, work at your job. You can make money by day trading at nighttime, or you can be swing trading even while you're at work and have your positions in the market. So if you want to learn more, I just gave an introduction to Forex today. This is not the full course. You're just seeing 1% of it. So there's a lot more that we have to discuss in other workshops. And here's the benefit. You're going to get over $4,000 worth of Forex courses. And you only need to do two things. All you have to do is open up an FXCM trading account. They're one of the world's foremost currency brokers, and as I said, they were pretty much my first broker that I started with back in 2002. So I have a lot of experience with FXCM, and they're very popular. Just open up one of those accounts and then also pay $40, and you'll be able to access $4,000 worth of Forex courses that I teach, also that past Cyber Trading University instructors taught that we've recorded, and you can view the recordings of these, as well as future workshops that I teach. So you get a lot of value for this. And I'm going to give everyone the link right here so you can click on it yourself and you can sign up directly through there. Also, if you have specific questions about this, or you're looking for a tailor-made plan, or you're looking for someone to basically guide you even further, you can call one of our education advisors at this number, and I'm going to input it right now. There we go, 877-702-9237, right there. So another benefit, and this is something a lot of people are going to be interested once you hear what I'm going to say, you also get a week of free access to our ever-popular cyber group chat room. And this is a stock-based chat room, at least during the daytime, during the regular stock market trading hours. And you can see our extremely skilled traders from Fausto Pugliese and Rich Lepis, who I've known for years, are phenomenal traders, are making a lot of money by trading these intraday stocks, NASDAQ stocks. And Fausto, the CEO and founder of CTU, Cyber Trading University, developed a revolutionary method using level 2 and total view, and he follows the smart money. Just like what I was showing you in the Forex market, he's done the same thing for NASDAQ stocks on intraday, and it works phenomenally. So you're able to come into this cyber group chat room and see how the whole system works. And I'm in there myself because I'm learning from Rich and Fausto, because I want to be doing what they do on intraday. And also at 4 p.m. Eastern Time after the stock market closes, I do a Forex and futures recap and swing trading. You can come in, ask me questions. At 12 noon lunchtime, Greg McDermott, our options instructor, goes and he explains various options positions that he and his followers have been watching. So there's a lot of value there. Doesn't really very little out of pocket for you. Virtually no risk at all, and at least you can get on the path to having an opportunity to start making money. Everyone's looking for ways to make money, and the world of jobs just ain't going to cut it. That's not how the world works anymore, where you can just work a 9-to-5 and retire. You need to do something extra, and I do that in my own life. I have multiple businesses, multiple streams of income. That's what I believe in. That's my philosophy. So trading is just another income stream that you can add, and this is one way to get started, just by learning the fundamentals and learning various trading techniques that I'm teaching within these courses. So call an education advisor, click on the link, you can get started yourself. And if you just think about the sheer numbers of people who are watching these presentations, it's hundreds and hundreds of people, not including when we post it on YouTube. Chances are some of you are going to be successful Forex traders. So that's definitely worthwhile. All right, so now I want to answer the questions finally. Got a backlog of questions, and I'm going to finally go in a first come, first served order. Okay, yeah, someone asked me if this webinar was recorded. Yes, it is. So I'll be posting on YouTube. If any of you follow me on Twitter, or even just the fact that you attended, we'll be sending out an email, and in that email we'll include the link to the YouTube video so you can review it. So do not fret if you missed part of it or you want to review it. Let's see. Donna asks me, in this current environment, does intervention make Forex trading riskier than stocks? I don't believe so at all. And, well, first of all, if you're sticking to the major currencies like the euro, US dollar, Canadian dollar, there really is a negligible amount of active intervention on the part of central banks. So then it's not like you're trading the Israeli shekel or Japanese yen, where it's a known fact that for years their central banks were trying to weaken their currency and trying to basically essentially manipulate the market. You don't have that if you stick to the major. Aside from Japanese yen, most traders are not trading the shekel anyway. I don't believe a lot of retail forex brokers even offer it. So I would not be concerned about that. Plus, you have to realize these interventions also find their way into the stock market. There was a recent intervention back, I think it was around Halloween time, late October 2014, where Bank of Japan significantly weakened the yen, and it caused the Nikkei, which is the Japanese stock index, as well as the U.S. stock indices, to surge. So these interventions affect all the markets. They are not isolated to the Forex market. And if anything, the interventions seem to show up pretty early on in the Forex market. So if you have a stop loss order, it'll get you out if they're having, let's say, an intervention like that. That's why you don't want to trade too overly leveraged. It's a little bit of a less is more type of situation with leverage. I think a little bit goes a long way. You want to amplify your returns a little bit. You don't want to put yourself at risk of taking a big hit if an adverse move affects you. So I advocate conservative type of trading, and there's no reason whatsoever why currency trading has to be riskier than stock trading. And in many ways, because it's such a smooth trading market, as long as you're sticking to the major currencies and currency pairs, because it's so smooth and because it's so liquid, you can get in and out so quickly. That gives me more confidence than I often have with trading certain stocks or certain types of futures. So that's one benefit. All right. Janice asks me, what time frames do I trade Forex? Well, obviously today I showed you the longer term time frame because that's when the smart money indicators tend to, that's when they have the most validity for or predictive value. It's not going to, for example, I think the commitment of traders reports only come out once a week. So for the sake of this presentation, I was showing you from the position of a swing trader. But what I do, I do trade intraday. I believe in intraday trading as well. There's no reason why you're limited to any one time frame. But what I do is, in my own trading, I take a general to specific approach in terms of analyzing time frames. So first, I want to analyze what's happening on the longer term scale. So I want to know what's happening on the weekly scale, longer term trends. I want to know what's happening on the daily scale. And then once I know that, then I use that to trade with the trend on intraday. So for example, if you notice a major bullish breakout in the British pound on the daily scale, and you just want to trade intraday, you don't want to hold overnight or whatever, all you have to do is start taking the long signals that are given on intraday. Because the market's a fractal, you'll see a lot of the same technical signals occur, whether it's on the weekly scale or on the 1 minute scale. So I start looking longer term and then narrow down to shorter term. But everyone has their own style. Some of you may even day trade and swing trade Forex. So it's a very versatile market that lets you cater it to your lifestyle and your situation. So that's a major benefit. All right, and Merv asks me, what are the pros and cons of Forex versus individual currency futures? Well, they move almost identically because the currency futures are designed to track Forex currency pairs or cash Forex. For most retail traders, I don't see any benefit of trading currency futures, especially because you're still able to get the smart money signals from currency futures. But the benefit of the Forex market itself, or cash Forex with a company like FXCM, is that it's more liquid. It's more actively traded. Whereas some of these currency futures, you can see spotty trading on intraday. It's definitely not as good for intraday traders. You won't see smooth trading on intraday. It's not as liquid. And I'm just trying to think, there's so many different nuances of it too. I mean, not that there's anything wrong with it's definitely a valid type of market, but when you're able to move that much money in cash Forex and do it so quickly in an electronic manner, I don't really see a lot of benefit of using currency futures, especially at nighttime, for example. There's less liquidity in them, in the currency futures compared to currency pairs, so you'll have spotty trading. So the transaction costs will be higher, slippage possibly, so I do prefer cash Forex. I like futures trading, but I would use futures trading for things like corn or oil or T-bonds, for example. Janice asked me, what's the minimum amount needed to fund an FXCM account? I believe it's $2,000. It could vary depending on the country. I don't want to give you a specific answer on that until it's a little more confirmed, but if you can just call one of those education advisors at 877-702-9237, then they'll answer it. Even if it's just a quick question, just call them up. They'll answer right away and help you out with that. Shiva asks me, do you still advocate FXCM after the Swiss debacle last month? That's a very good question and something I've been answering for some time since I started this program with CTU. I am not concerned about what happened now, especially now that debacle with the Swiss franc is over. Okay, so here are different reasons why, and there are many different reasons. First of all, FXCM was bought out by Leucadia, which is a very well-financed investment company. I believe they have $25 billion of capital. So FXCM is better capitalized now than it was before this issue that occurred with the Swiss franc debacle. So that's definitely one good thing, is you have this major parent company that is well capitalized, and they're not going anywhere anytime soon. So that definitely should allay a lot of fears. Also, all the customers who had money in FXCM, as long as they didn't trade the Swiss franc, as long as they didn't short the Swiss franc, that is, they still have their money in their account. So that's the nice thing, is it's not like FXCM went under and took their clients' money. Nothing like that happened. A few years ago, MF Global was a major broker, mostly focused on futures, and they went under, and a lot of their customers lost money. Eventually, there were a whole bunch of lawsuits years later, and finally, the clients gained back a good portion of their funds. But nothing of the sort happened with FXCM, which is very nice. Also, here's another way. I'm going to give you guys a tip how to avoid getting caught in a major move like what happened in the Swiss franc. To summarize, for those of you who are not aware, the Swiss franc soared 25% in about 5 minutes. It was last month, back in January. And the reason why is because the Swiss National Bank unpegged the Swiss franc to the U.S. dollar. They were pegged. They were basically tied together to have a closely traded exchange rate, just because these countries are these currencies, these blocks are so close to each other, and with all the tumultuous things that were happening in the Eurozone, the SNB wanted to avoid the Swiss franc from appreciating too much. And the reason why is because people were pulling out of Europe. You had people in Spain, people in Greece who had money and said, I don't want to keep my money in this country's banks. I want to move it to Switzerland. So they were all converting their capital into Swiss francs and putting it into Swiss investments, and it caused the Swiss franc to appreciate too much against the euro, which then hurt the country's exports, companies like or like products like Rolex, for example, or many luxury goods are Swiss exports, and they were getting hurt by this appreciation of their currency. So the S&P back in 2011 tied the Swiss franc to the euro, and then recently in January they unpegged it, or they untied it and tried and made it freely floating again. And that within minutes it caused this currency to soar. So anyone who was shorting the Swiss franc took a hit if they were excessively leveraged. So here's my advice to you. If you want to avoid that scenario, don't trade pegged currencies. And the benefit is that there are right now that the Swiss franc has been unpegged, there really are no major pegged currencies aside from the Hong Kong dollar. And some currency brokers may offer it, but it doesn't really trade much because it's pegged. It doesn't really move much. Some sophisticated traders, or usually hedge fund traders, may try to bet on the unpegging of the Hong Kong dollar to the US dollar. But for most retail traders would have no interest trading the Hong Kong dollar. I would advise against it. Just don't even go there. It's not worth it. It's not enough movement to make it worth your while. So as long as you're sticking with the euro or the Canadian dollar or Australian dollar, they're not pegged currencies, so you're not going to have that type of move. You will have moves, but they'll play out over weeks and months, and you'll have time to position yourself accordingly, or even if it goes against you, your stop loss will get hit, and you'll get out. So that's why I'm not concerned about another scenario like what we saw with the Swiss franc. And also, that's my third point is do not trade excessively leveraged. If a broker gives you 50-to-1 leverage, doesn't mean you have to take it. It does exist, but I would say do a fraction of that. Do a tenth of that. Do 1-to-5 leverage, for example. If you have $1,000, you're trading let's say $1,000, trade with a maximum of $5,000, and then at the very least, you're not putting your trading account in jeopardy. And then when you get very good, just through repetition and through training, education, and you want to scale up, maybe you'll go to 1-to-10 or 1-to-15. And leverage is inherent in the futures market too. Many futures contracts are even more leveraged in terms of a leverage ratio than Forex is. It's very common for certain futures contracts to have a leverage ratio of anywhere from 15 to 40 or so, or maybe even, it really depends on the margin requirements that are set by the various exchanges, but futures themselves can be very leveraged. So, and the problem with futures is that there's a minimum initial margin that's necessary to buy or sell one futures contract, and it's oftentimes a couple $1,000s, which doesn't seem like a lot, and it's not a lot in terms of actual capital, but if you see how much it's levered, you're trading with tens of thousands of dollars. It could be $50,000, $60,000, $70,000 of notional market exposure, which for a small trader with a couple $1,000s is just too much exposure to the market. So the benefit of Forex is that if you only want a maximum of $5,000 or $10,000 of exposure to the currency market, you can get that because it gives you that opportunity to vary your exposure. So that's why Forex is wonderful for beginners. Futures is definitely something for more advanced traders. All right, let me read through. Eric asks me, how can you tell if a currency is pegged? I don't know all the currencies that are pegged out there. I'm sure there could be some smaller currencies that most traders are not even involved with whatsoever. So it's really just a moot point. But the major one that sticks out in my mind is the Hong Kong dollar. But if you look at the chart of the Hong Kong dollar against the US dollar, it really does nothing. It just trades in a range because it's pegged. So I would advise just stay away from the Hong Kong dollar if you're worried about a Swiss franc type of scenario. But everything else you should be fine with. You should be fine with the euro, the US dollar, Canadian dollar, Australian dollar, New Zealand, British pound. There's more than enough trading opportunities with those currencies so that you don't have to worry about trading some of the more exotic ones where maybe you could experience an unpegging type of scenario. All right, Naja asks me, what times during a 24-hour period are the most active? A lot of it depends on the currency that you're trading itself. So let's say in the case of a currency pair that involves the Japanese yen, the Japan trading session will oftentimes be the most actively traded. So if you're based in the U.S., that trading session starts around 8 p.m. Eastern time. If you're in New York like I am, it'll start around 8 o'clock at night. And that's when that starts. And then European trading will start usually around 3 a.m. or so, right around that time. So that'll be when the euro will start to be more active. That a lot of times, when each different currency trading session, that's when news related to those various currencies and economies starts to come out, and that's what causes a lot of trades. So when Japan opens up, you'll have news related to the Bank of Japan or Japanese corporate earnings reports will come out, so you'll have more active trading, or GDP reports, economic data will come out in the Japanese trading session. You'll have more active trading in that particular currency, and so on and so forth. New Zealand dollar will open up. New Zealand dollar usually starts trading more actively on a Sunday night if you're here in the U.S., because that's one of the first ones to open up at the start of the week, and that opens up even before Japan. So you'll see news come out from New Zealand. That'll cause the New Zealand dollar to move around quite a bit. So, but if I were you, I would just look at the trading of the past few weeks and look with your own eyes and determine when most of the moves have occurred. Were they occurring around 3 a.m. Eastern? Are they occurring in the U.S. trading session? It really depends on where the news is. Like right now, Europe is the big focus. Other times it'll be Japan. Other times it'll be the U.S. So it really all depends, but those are some general guidelines. All right, so, and then Mark asks me, are ETFs acceptable for Forex trading? There are many different ways of trading currency trends. Futures are one. Cash Forex is the most obvious one. There are also currency ETFs. They can have a role. I'm not so much of a fan of them, though, if you're really interested in trading Forex, because, first of all, you're limited to trading in the U.S. trading session, so that's from typically around 8:30 a.m. Eastern, if there is pre-market trading in these currency ETFs, and they close around 4 p.m. And then during the day, if you look on the intraday charts of these currency ETFs, they're not very liquid. They're not actively traded compared to cash currencies. So it's very choppy on intraday. So you're going to have higher transaction costs. You're not going to be able to move in and out as smoothly as you would if you're trading cash currencies. Another problem too, and this is a big issue, is that when that ETF closes for trading at 4 p.m. in the U.S. session, and let's say there's a big move overnight, you're not going to be able to get in or get out. So you're pretty much doing away with one of the major benefits of Forex, which is 24-hour trading. So let's say Japan makes a bigger intervention and it goes against you. At least with cash Forex, like you'd have with an account like FXCM, you can get out. Your stop losses can get hit and execute. Whereas with an ETF, you're going to have to wait until the next morning before you get out, so that a losing trade can get even worse than you think. So it can be a valid strategy for some types of swing traders who want to get some degree of exposure, but it's definitely not my first choice. And also, you don't have access to the kind of leverage that you would have with with a broker like FXCM, a currency broker, where you're getting leverage. You're only going to be limited to the leverage that you're pretty much going to have the same leverage as a stock trader, unless you're trading a leveraged ETF, but then those are even less liquid and they tend to move in an unpredictable, erratic manner. So it's really not the best solution. It's kind of like a quick and dirty solution. But there's many different ways of skinning the cat with these markets. There's so many financial products. It's just mind-boggling. All right, so you folks have any more questions for me, or? Definitely not the last webinar I'll be doing. So if you can think of webinars from now until then, or if you're in our cyber group, whether you're a member of cyber group or you get 1 week of free access to cyber group because you signed up for FXCM through that plan I showed you, you can come on in, ask me questions because I have a 4 p.m. meeting every day, and I do a market recap and talk about the day's economic news and what I foresee going ahead. So you'll be seeing more of me, hopefully. All right. I can't believe it's already the weekend. This week flew by, thankfully, and we had 3-degree weather here in New York, so it's really beating us up here. I'm just in the mood to sleep. I can barely think about anything else. All right, folks. Happy trading. Talk to you guys soon. Take care. Bye.